For many American households, the electric bill is becoming harder to treat as a background expense. It is now another recurring pressure inside the monthly budget. After groceries, gasoline, rent, insurance, and debt payments, electricity is supposed to be one of the predictable bills. A family turns on the lights, runs the air conditioner, charges phones, cooks dinner, and expects the cost to stay within a familiar range. The latest data points in a different direction. In May 2026, the electricity index was up 5.9% from a year earlier. The average U.S. electricity price reached 19.6 cents per kilowatt hour. For households, those numbers do not appear as economic abstractions. They appear as bills that are more difficult to absorb, and this pressure is arriving before the AI boom reaches its projected peak. This is not simply a story about artificial intelligence using electricity. It is a story about a power system entering a new period of demand growth after many years of relative flatness. Utilities, grid operators, regulators, data centers, businesses, and households are connected through the same electric system. When that system needs more power plants, more transmission lines, more grid capacity, and more reliability spending, the cost does not remain inside the industry. Over time, it can move toward customers. That includes ordinary households. For years, electricity demand in the United States grew slowly. The grid still required maintenance. Utilities still invested in equipment and reliability. But the country was not facing the same kind of demand acceleration now appearing in official forecasts. The Energy Information Administration says U.S. electricity consumption rose 2.1% per year on average over the last 5 years, after roughly 15 years of nearly flat demand. That shift matters. A flat demand grid and a growing demand grid are different economic systems. When demand is flat, utilities can often work within existing infrastructure. When demand begins rising again, the questions change. Where will the power come from? Can the grid deliver it? Who pays for the upgrades? And how quickly do those costs reach monthly bills? The EIA projects U.S. power demand rising from 4,195 billion kilowatt-hours in 2025 to 4,271 billion kilowatt-hours in 2026, and then to 4,397 billion kilowatt-hours in 2027. The country is not only using more electricity, it is expected to set new records. For households, the most important issue is not only the size of national demand. It is the direction of the system. Higher demand can require more investment. More investment can require cost recovery. And cost recovery often happens through rates paid by customers. That is how an industrial pressure becomes a household pressure. One of the largest new demand sources is the data center. Data centers are the physical infrastructure behind cloud computing, streaming, search, business software, and artificial intelligence. They are large facilities filled with servers. Those servers need electricity to operate. They also need cooling systems to keep running. The International Energy Agency projects global data center electricity use could double to around 945 terawatt-hours by 2030. It also says the United States and China account for nearly 80% of global growth. That does not mean every household electric bill is caused by AI. That would be too simple, and it would not be accurate. It does mean AI and data centers are becoming a serious demand factor in the power system. They are adding pressure to a grid already dealing with other pressures. The EIA says demand growth is being driven by AI data centers, cryptocurrency, and broader electrification. Reuters reported that commercial power sales are expected to outpace residential sales in 2026 for the first time on record. That detail is important. The strongest demand growth may not be coming from families using more electricity at home. It may be coming from commercial users including data centers and other large loads. Households can still feel the cost. A family does not need to build a data center to pay a higher electric bill. If a utility expands the grid, builds new infrastructure, secures more capacity, or recovers approved costs through rates, the pressure can reach residential customers. This is the hidden system behind the story. Electric bills do not only reflect the electricity a household used that month. They can include generation costs, transmission costs, distribution costs, capacity market costs, storm hardening, reliability spending, and approved utility investment. They can also reflect fuel costs, local regulation, and regional supply constraints. That is why a bill can rise even when a family's behavior has not changed. A household may use the same lights, the same refrigerator, the same air conditioner, and the same washing machine. But the cost of serving the system around that household can still move higher. That is the economic meaning of rising electricity demand. It is not only about consumption, it is about infrastructure. In some regions, capacity market prices are already sending a signal. PJM, the largest U.S. grid operator, reported that its 2026 and 2027 capacity auction cleared at $329.17 per megawatt day. That was above the prior RTO price of $269.92 per megawatt day. Capacity prices are not the same as a household's monthly bill. They are part of a larger electricity market structure. They matter because they show that the cost of ensuring enough power supply is rising in an important region of the country. For ordinary people, the market mechanism is difficult to see. The result is easier to understand. Keeping the lights on during peak demand can become more expensive. When reliability becomes more expensive, the cost has to be recovered somewhere. That is where the household enters the story. A retiree on a fixed income does not think in megawatt days. A family with children does not think in grid capacity auctions. A small business owner does not think in terawatt hours. They think in monthly bills. They think about whether the summer electric bill will be higher than last year. They think about whether they can run the air conditioner during a heat wave. They think about whether another fixed cost is reducing money available for groceries, medicine, insurance, or debt payments. This is why the timing matters. The AI boom is often discussed as a future event. More data centers, more servers, more demand, more power. But bill pressure is already visible. BLS data showed electricity prices up 5.9% over the 12 months ending May 2026. Reuters reported that residential electricity prices were forecast to rise 5.1% in 2026 and 2.4% in 2027 before inflation adjustment. Households may experience rising electricity costs before the largest projected AI demand arrives. The system prepares early. Utilities do not wait until every data center is fully operating before planning infrastructure. Grid operators do not wait until demand reaches its peak before thinking about capacity. Regulators may approve projects years before customers see the full benefit. Reuters reported that policymakers are increasingly allowing utilities to charge customers for power plants and transmission lines before they are built. That can raise bills in the near term, even when the promised benefit is long-term reliability or future capacity. This is a central pressure point. New infrastructure may be needed. The grid may require upgrades to serve a growing economy, support reliability, and handle new demand. But the household question remains: who pays? When do they pay? And how much of the cost should fall on ordinary customers? That question is especially important because data center growth is not spread evenly across the country. It is concentrated in specific regions. including areas with large power demand and active grid constraints. The research points to Texas as one example of stronger demand growth. Reuters reported that EIA projected Texas demand growth of 10% from 2025 to 2027 in a base case, and 15% in a high-demand scenario. That does not mean every Texas household will see the same bill effect. It does show why regional pressure matters. Electricity is local and regional. A national average can hide the places where the grid is under more strain, where data centers are more concentrated, or where utilities are requesting larger investments. The story should not be reduced to one national number. It is a system. Demand rises, utilities plan, grid operators adjust, capacity costs move, regulators approve spending, customers receive bills. Each step may appear technical. The final step is personal. For a middle-class household, the electric bill joins a list of costs that are already difficult to manage. Gasoline affects commuting. Grocery prices affect every shopping trip. Insurance affects home ownership. Rent and mortgage payments shape the entire monthly budget. Debt payments reduce flexibility. Electricity is different because it is essential. A household can delay some purchases. It can switch brands at the grocery store. It can drive less when possible. Electricity is harder to avoid. Cooling, heating, refrigeration, lighting, communication, medical devices, and basic comfort all depend on it. That makes rising electric bills especially sensitive. The burden can be heavier for older Americans, families with children, renters who pay their own utilities, and small businesses with high energy needs. A restaurant cannot simply stop using refrigeration. A laundromat cannot operate without power. A convenience store cannot run coolers without electricity. A small manufacturer cannot ignore higher utility costs. Those business costs can also move outward into prices paid by customers. So the electric bill is not only a household bill, it is also part of the cost structure behind local services. The pattern is familiar. An industry pressure becomes a supply chain pressure. A supply chain pressure becomes a price pressure. A price pressure becomes a household consequence. In this case, the chain is clear. AI data centers and broader electrification increase demand. Growing demand puts pressure on power supply, grid capacity, and infrastructure. Utilities and grid operators respond with investment, planning, and market signals. Those costs may move into electricity rates. Households see higher monthly bills. Accuracy is important. It would be misleading to say AI alone is responsible for rising electric bills. The verified research does not support that claim. Electricity bills are affected by many factors: fuel costs, transmission and distribution upgrades, storm hardening, local regulation, capacity markets, weather, and long-term infrastructure spending. AI is a major new pressure. It is not the whole story. That distinction makes the issue clearer, not weaker. America's power system is being asked to do more. At the same time, households are already financially stretched. Demand is rising, infrastructure needs are rising, reliability costs are rising in some markets. Consumer electricity prices are already moving higher. The AI boom may accelerate the pressure, but bill pressure has already started. That is the current position. U.S. electricity demand is expected to reach new records in 2026 and 2027. Commercial power demand is becoming more important. Data centers are a major growth factor. Capacity costs in key markets show stress. Regulators and utilities are making decisions now that could affect future bills. What remains uncertain is how much of the cost will be assigned to large commercial users and how much will be shared across ordinary customers. That question will shape the household impact. If large power users pay more directly for the grid expansion they require, residential customers may be more protected. If costs are spread broadly, families could see more of the burden in monthly bills. For now, the most careful conclusion is also the most important one. Electric bills are rising before the AI boom peaks. For millions of Americans, the future of artificial intelligence may first appear not on a screen, not in a workplace, and not in a headline. It may appear in the utility bill,